Good morning, Tyler and Mia. I'm Randall Lee, and thanks for meeting in this way. I was hoping we could meet in person, but unfortunately, since we're both on the road, I thought this was the best way for us to meet since you were very interested in getting your financial plan, and our firm has done a lot of work for you. So first, I just wanted to go over some of the main retirement goals that we're going to be able to help you achieve. Number one, we're going to be able to allow you to retire at age 62, and that in the process you'll be receiving 85% of your current income during your retirement years. However, in order to achieve this goal, we hope that you, Tyler, can contribute around $8,000 per year, and you, Mia, can contribute around $3,928 per year into your 401ks. That way, your monies grow tax deferred and help prepare for your retirement. We've also developed a plan that will enable you to fund Becky's college education. Uh, so one of your key goals is to see her off to a 4-year college within 13 years, since she's 5 years old right now. And you do have a nice collection of Series EE bonds that you will be able to help fund her college education with. But in addition, if you made annual contributions of around $3,091, you will be able to develop sufficient not only tax deferred but tax free savings for her college education, especially if it's in a 529 college saving plan. Third, it appears that we've developed a plan that will allow Mia to build the home addition upon retirement, to store and do her arts, and also to open up a small art gallery in downtown Springfield. Definitely two viable retirement goals. We've also developed a financial plan that will enable you to uh, do some estate planning and avoid probate by properly creating not only wills but living trust documents. Fifth, we hope to improve your current investment returns without taking unnecessary risks. We've looked at your retirement plans and how the monies are currently invested, and by working with a number of financial services firms, plus our own calculations and forecasts, we have found ways in which we can increase the expected rate of return of your retirement funds, lower the risk of those holdings, and therefore maximize what is known as your risk-adjusted returns between now and throughout your retirement years. Sixth, we hope that you can obtain sufficient insurance to protect against either premature death or disability. And we would like both of you to take out additional term life policies for a period of around 20 years. That's your income generating years, so that you can protect one another in case some type of calamity happens. And while your disability insurance is rather good through your employers, there was some additions and amendments that we would like to recommend to you a little later on in this presentation. Seven, one of your goals is to create an emergency fund where you'll have 6 months of cash and cash equivalents that would cover your non-discretionary spending. And we've been able to find a way for you to do that basically by lowering your expensive credit card debt and your auto loan, all expensive forms of consumer credit. You'll be able to improve your cash flow beginning in tax year 2014 and beyond. And with those savings, as well as additional savings in future years, contributed to a tax-free money market fund, the Missouri Municipal Money Market Account, which pays over 3% on an after-tax basis, we'll be able to develop your emergency funds so that it covers approximately 3 months or more of your total expenses and 6 months or more of your non-discretionary expenses very shortly and into the years ahead. Eighth, we want to lower your borrowing costs on your mortgage. Currently, you have a mortgage that has 20 years to go and it's at a rate of 7.875%. We should be taking advantage of this drop in mortgage rates. You can currently get a mortgage of around 4.65%. And if you were willing to increase the term of your mortgage somewhat, you would be able to lower your monthly cost that you pay for your mortgage by over $300, closer actually to $400 each month. So it's because of that that in 7 we will be able to help build up your emergency funds. And then some additional goals that we would like to help you with. It appears that both you and Mia are not having, or you're having too much money withheld by your employer in terms of payroll tax withholdings, and we'd like you to increase the number of exemptions you have by adjusting your W-4. And we provided that form for you, and that way you'll be able to pay less in terms of tax withholdings. And the whole idea is that considering the time value of money, you always want to receive money as quickly as you can. You want to accelerate your cash inflows, and you want to defer your cash outflows. So tax withholdings, that is a cash outflow to you, while the refunds that you're getting from the federal government and the Missouri state government, that is considered a tax inflow. So we want to increase your withholding to accelerate those inflows. Going on to some additional ideas, we did discuss reducing your overall debt to improve your cash flow and rid you of rather expensive consumer debt. Another additional goal is that Tyler, you are able to enter a flexible spending account for your medical expenses at work, and because it appears that your annual expenses are roughly a little bit over $1,000, if you contributed around $39 every pay period, every 2 weeks, to a flexible spending account, you would be able to reduce your taxable income and also provide for the medical, dental, and vision expenses that you too are currently experiencing on a rather regular basis. And then in terms of reviewing your life insurance, we had talked a little bit about this before, but importantly, we want to make sure that both of you are protected if one would predecease the other for whatever reason. And it's most important that you protect each other by providing sufficient income to your partner, especially to make up for the lost income that you would have been experiencing during the next 20 years, your income generating period. At the same time, there is also the possibility that both of you may pass on, and that you would want to be able to provide for Becky, especially during both of your income producing years. So term insurance is insurance that would cover the 3 of you and other beneficiaries for the next 20 years. It would be very good, and later on in our analysis we have some estimates on how much additional coverage you should have in addition to what you already have through your employers. Concerning disability insurance is a little more complex because it's meant to cover the income that is lost by the injured party. And while both of you have rather good plans, in the case of Tyler, you have a plan where your short-term disability coverage begins immediately and lasts for 90 days, and then for the next 90 days, for the next 90 days after the short-term coverage ends, you have long-term coverage that kicks in. However, it is at a lower reduced percentage. So it generally takes about 7 months for Social Security disability insurance to kick in. So in months 4, 5, 6, and 7, we suggest that you save uh, approximately $4,373 for the next 2 years to overcome that shortfall between the time that your long-term disability at somewhat reduced payments compared to short-term disability begin, and then Social Security augments that in month 7. Okay, and we'll go over that again later on in the presentation. Concerning your homeowner's insurance, we suggest that you increase your liability coverage to at least 300,000. Liability coverage would cover you to protect you to in the case that, say, you had a guest on your property and somehow they hurt themselves. Okay, items like that. And your auto insurance looked fine to us. Something that you may want to consider is possibly increasing the deductible. That would lower your monthly and annual premiums, but otherwise it looks fine to us. You seem to be properly covered. And then we did notice that your watercraft is not covered by any type of insurance. So we have found a comprehensive policy that covers you for both property and casualty, and the annual premiums on that would be around $200 per year. Okay, so this is the first section of the presentation, and next I'm going to go over into some of the general assumptions and both your cash flow statements and your balance sheets, how we could make adjustments to them to build your emergency fund and improve your cash flow. Thank you.